Question 1. In Ohio, what is the minimum free look period for a newly issued life insurance policy? A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. Ohio law mandates a minimum 10-day free look period, also known as the right to examine period, for newly issued life insurance policies. This allows the policy owner to review the policy after delivery and return it for a full refund of the premium if they are not satisfied. This period ensures consumer protection by giving them time to fully understand what they have purchased. Remember, the free look period starts when the policy is delivered to the policy owner, not when it's issued. Question 2. An Ohio life insurance policy's incontestable clause generally prevents an insurer from denying a claim based on misstatements in the application after the policy has been in force for a specific period. What is this period? A. 6 months. B. 1 year. C. 2 years. D. 5 years. Answer: C. 2 years. The incontestable clause in an Ohio life insurance policy typically states that after the policy has been in force for 2 years, the insurer cannot deny a death claim due to misstatements or concealment in the application, unless the misstatement was fraudulent. This clause protects policy beneficiaries from an insurer attempting to void a policy years after it was issued, ensuring more certainty for claims. It essentially sets a time limit for the insurer to discover honest mistakes or omissions made by the applicant. Question 3. What is the primary purpose of the Ohio Life and Health Insurance Guaranty Association? A. To regulate insurance rates and policy forms in Ohio. B. To protect Ohio policy owners, insureds, and beneficiaries against the insolvency of an insurer. C. To provide continuing education for licensed insurance agents in Ohio. D. To resolve disputes between insurance companies and their agents. Answer: B. To protect Ohio policy owners, insureds, and beneficiaries against the insolvency of an insurer. The Ohio Life and Health Insurance Guaranty Association acts as a safety net for consumers, protecting them financially if a member insurance company becomes insolvent or unable to meet its obligations. It steps in to pay covered claims up to certain limits, thereby safeguarding policy owners' benefits. This vital association maintains public trust in the insurance industry by providing a measure of security. Think of it as a state-level FDIC for insurance policies. Question 4. In Ohio, when an existing life insurance policy is replaced, the replacing insurer must provide the applicant with a notice regarding replacement. What is the purpose of this notice? A. To explain the benefits of the new policy compared to the old one. B. To advise the applicant that they are giving up rights and benefits when replacing a policy. C. To guarantee the new policy will have lower premiums than the old one. D. To waive the free look period for the new policy. Answer: B. To advise the applicant that they are giving up rights and benefits when replacing a policy. Ohio regulations regarding policy replacement require the replacing insurer to issue a notice regarding replacement to the applicant. The primary purpose of this notice is to inform the applicant that they might be giving up valuable rights, benefits, and potentially incurring new fees or higher premiums when replacing an existing policy. This crucial disclosure ensures the consumer understands the potential disadvantages and makes an informed decision, preventing harmful churning of policies. Always emphasize to clients that replacement might not be in their best interest without careful consideration. Question 5. Which of the following is a characteristic of a universal life insurance policy in Ohio? A. It has a fixed premium and fixed death benefit. B. It offers flexible premiums and an adjustable death benefit. C. It requires the policy owner to invest directly in the stock market. D. It provides coverage only for a specified period, after which it expires. Answer: B. it offers flexible premiums and an adjustable death benefit. Universal life insurance is characterized by its flexibility, allowing policy owners to adjust premium payments and the death benefit amount within certain limits. Unlike traditional whole life, which has fixed premiums, universal life policies separate the savings element from the insurance coverage, offering transparency on costs and earnings. This adaptability makes it suitable for individuals whose financial needs or ability to pay premiums may change over time. Question 6. A life insurance policy's grace period in Ohio typically allows for how many days for a premium to be paid past its due date without the policy lapsing? A. 10 days. B. 20 days. C. 31 days. D. 60 days. Answer: C. 31 days. In Ohio, a life insurance policy typically includes a grace period of 31 days, during which coverage remains in force even if the premium is not paid on its due date. This provision gives the policy owner extra time to make the payment and prevents the policy from lapsing immediately. If the insured dies during this grace period, the death benefit will be paid, minus any unpaid premium. This is a standard consumer protection feature. Question 7. What does the blackout period refer to in relation to Social Security survivor benefits? A. The period before a policy's incontestable clause takes effect. B. The period during which a surviving spouse is not eligible for Social Security survivor benefits. C. The period when a policy's cash value is zero. D. The period when an insurer cannot issue a new policy due to regulatory restrictions. Answer: B. The period during which a surviving spouse is not eligible for Social Security survivor benefits. The blackout period refers to the time frame during which a surviving spouse, after their youngest child turns 16, or earlier if the child is no longer a dependent, is no longer eligible for Social Security survivor benefits, until they reach age 60. This gap in income can create a significant financial hardship for the surviving spouse, making proper life insurance planning crucial to bridge this period. Life insurance can be used to provide income replacement during this specific vulnerable time. Question 8. Who benefits from the waiver of premium rider on a life insurance policy? A. The policy owner, by waiving future premium payments if they become totally disabled. B. The beneficiary, by receiving an increased death benefit if the insured becomes disabled. C. The insurer, by being able to collect premiums even if the policy owner is disabled. D. The policy owner, by receiving a cash payout upon disability. Answer: A. The policy owner, by waiving future premium payments if they become totally disabled. The waiver of premium rider is a valuable addition to a life insurance policy that protects the policy owner. If the insured becomes totally and permanently disabled before a certain age, this rider waives future premium payments for the duration of the disability, ensuring the policy remains in force. This prevents the policy from lapsing due to the inability to pay premiums during a period of financial strain. It's an important safeguard for the policy's continued coverage. Question 9. Which of the following is not typically a non-forfeiture option in a whole life insurance policy? A. Cash surrender value. B. Extended term option. C. Reduced paid-up insurance. D. Waiver of premium. Answer: D. Waiver of premium. Non-forfeiture options are choices available to a policy owner who decides to surrender a whole life policy that has accumulated cash value. These options are cash surrender value, taking the cash, extended term option, using cash value to buy a single premium term policy for the same death benefit, and reduced paid-up insurance, using cash value to buy a lower face amount paid-up whole life policy. Waiver of premium, however, is a rider that waives premium payments if the insured becomes disabled, not a non-forfeiture option. Question 10. According to Ohio law, how long must an insurance producer typically keep records of insurance transactions? A. 1 year. B. 3 years. C. 5 years. D. 7 years. Answer: B. 3 years. In Ohio, insurance producers are generally required to maintain records of insurance transactions for at least 3 years. These records include applications, disclosures, and any other documents related to the sale of insurance policies. This requirement ensures that adequate documentation is available for regulatory review and consumer protection purposes. Maintaining accurate records is a fundamental responsibility for all licensed agents. Question 11. An insured in Ohio takes out a policy loan against the cash value of their whole life insurance policy. If the insured dies with an outstanding loan, what effect does it have on the death benefit? A. The death benefit is paid in full, and the loan is forgiven. B. The outstanding loan balance is deducted from the death benefit paid to the beneficiary. C. The beneficiary is responsible for repaying the loan directly to the insurer. D. The policy lapses, and no death benefit is paid. Answer: B. The outstanding loan balance is deducted from the death benefit paid to the beneficiary. When an insured dies with an outstanding policy loan, the loan amount plus any accrued interest is deducted from the death benefit payable to the beneficiary. A policy loan is essentially an advance against the policy's cash value, not a separate loan, so the cash value is reduced by the loan amount. This ensures that the loan is repaid and the remaining proceeds are distributed as intended. Question 12. What is the primary distinction between a variable life insurance policy and a whole life insurance policy in Ohio? A. Variable life has a fixed death benefit, while whole life has an adjustable one. B. Variable life policies do not accumulate cash value, while whole life policies do. C. Variable life allows the policy owner to direct the investment of cash value into a separate account, while whole life has guaranteed cash values. D. Variable life is always term insurance, while whole life is permanent. Answer: C. Variable life allows the policy owner to direct the investment of cash value into a separate account, while whole life has guaranteed cash values. The key difference between variable life and whole life insurance lies in the investment component of the cash value. Variable life policies provide the policy owner with control over how the cash value is invested, typically in a separate account with various subaccounts, which means the cash value and death benefit can fluctuate based on market performance. Whole life policies, conversely, offer guaranteed cash values and death benefits that are not directly tied to market performance, with the insurer managing the investments. Due to the investment risk, variable life producers in Ohio must hold both a life insurance license and a securities license. Question 13. Which of the following is a prohibited act for an insurance producer in Ohio? A. Charging a fee for services not customarily provided by the insurer. B. Representing multiple insurance companies simultaneously. C. Misrepresenting the terms, benefits, or advantages of any insurance policy. D. Attending a continuing education course sponsored by an insurer. Answer: C. Misrepresenting the terms, benefits, or advantages of any insurance policy. Misrepresenting the terms, benefits, or advantages of any insurance policy is a serious prohibited act for an Ohio insurance producer. This falls under the broader category of unfair trade practices, which aims to protect consumers from deceptive sales tactics. Such actions can lead to license suspension, revocation, and significant fines, as the integrity of the insurance transaction relies on accurate information. Always be truthful and transparent with clients. Question 14. An insurable interest in a life insurance policy must exist at what point in time in Ohio? A. Only at the time the policy is applied for. B. Only at the time of the insured's death. C. Both at the time of application and at the time of the insured's death. D. It is not required to exist at any specific time, only that it be declared. Answer: A. Only at the time the policy is applied for. For life insurance, an insurable interest must exist at the time the policy is purchased or applied for, meaning the policy owner would suffer a financial or emotional loss if the insured were to die. It is not required to exist at the time of the insured's death. For example, a business might purchase a policy on a key employee, and if that employee later leaves the company, the policy can still remain in force, as insurable interest existed at inception. Question 15. The entire contract provision in an Ohio life insurance policy states that the policy and a copy of the application constitute the complete agreement between the policy owner and the insurer. What is the primary purpose of this provision? A. To allow the insurer to change policy terms without notice. B. To prevent the insurer from making changes to the policy after it is issued. C. To prevent disputes by ensuring all agreements are contained within the policy document. D. To require the policy owner to sign a new agreement every year. Answer: C. To prevent disputes by ensuring all agreements are contained within the policy document. The entire contract provision ensures that the policy document, along with the attached application, represents the complete and sole agreement between the policy owner and the insurer. This provision prevents either party from referring to outside documents or oral statements to modify the policy's terms or to deny a claim. It provides clarity and prevents future disputes by consolidating all contractual obligations into one comprehensive document. Question 16. What is the main characteristic of a level-term life insurance policy? A. The premium increases each year, but the death benefit remains level. B. Both the premium and the death benefit remain constant throughout the policy term. C. The death benefit decreases each year, while the premium remains level. D. Both the premium and the death benefit fluctuate based on market performance. Answer: B. Both the premium and the death benefit remain constant throughout the policy term. A level-term life insurance policy is characterized by both a constant, level, premium and a constant, level, death benefit for the entire duration of the policy's term. This predictability makes it easy for policy owners to budget for premiums and ensures a consistent payout amount. This type of policy contrasts with decreasing term, where the death benefit declines over time, or increasing term, where it grows. Question 17. The Ohio Superintendent of Insurance has the authority to do all of the following except: A. Conduct examinations of insurers' books and records. B. Issue, suspend, or revoke insurance producer licenses. C. Enact state laws related to insurance. D. Impose fines for violations of the Ohio Insurance Code. Answer: C. Enact state laws related to insurance. The Ohio Superintendent of Insurance, as the chief insurance regulator, has broad powers, including conducting examinations, issuing and revoking licenses, and enforcing the Ohio Insurance Code, which includes imposing fines. However, the superintendent's role is to administer and enforce existing laws, not to enact new ones. Enacting state laws is the responsibility of the state legislature. Question 18. An insurance producer in Ohio must disclose to an applicant that information may be gathered from which of the following sources for underwriting purposes? A. A medical information bureau, MIB. B. Public social media profiles. C. Personal financial statements without consent. D. Direct communication with the applicant's employer regarding salary. Answer: A. A medical information bureau, MIB. When applying for life insurance, an Ohio producer must inform the applicant that information may be obtained from various sources for underwriting, including the Medical Information Bureau, MIB. The MIB is a nonprofit organization that maintains a database of medical and health information to help insurers detect fraud and identify misrepresentations. This disclosure ensures transparency in the underwriting process and protects consumer privacy under regulations like the Fair Credit Reporting Act, FCRA. Question 19. If a life insurance policy owner in Ohio wants to make a permanent change to their beneficiary designation, what method is generally required? A. An oral request to the insurer. B. A written request to the insurer. C. A notarized statement filed with a county clerk. D. Any method, as long as the insurer is informed. Answer: B. A written request to the insurer. To make a permanent change to a life insurance policy's beneficiary designation in Ohio, the policy owner generally must submit a written request to the insurer. This ensures a clear, documented record of the policy owner's intent, minimizing future disputes and protecting both the insurer and the designated beneficiary. Oral requests are typically insufficient because they lack a verifiable paper trail. Always ensure your clients understand the importance of updating beneficiaries in writing. Question 20. What is the primary purpose of the reinstatement provision in a life insurance policy? A. To allow the policy owner to receive a full refund of premiums paid. B. To permit the policy owner to reapply for coverage without new underwriting. C. To restore a lapsed policy to its original terms and benefits, often requiring back premiums and proof of insurability. D. To automatically convert a term policy into a whole life policy. Answer: C. To restore a lapsed policy to its original terms and benefits, often requiring back premiums and proof of insurability. The reinstatement provision allows a policy owner to reactivate a lapsed life insurance policy, typically within a certain time frame, e.g., 3 to 5 years, after it has terminated due to non-payment of premiums. To reinstate, the policy owner usually must pay all overdue premiums plus interest and provide satisfactory proof of insurability, meaning the insured is still in good health. This provision is beneficial because it restores the policy's original policy date, avoiding higher premiums that would apply to a new policy at an older age. Question 21. Which type of life insurance policy offers policy owners the most control over the investment of cash values, but also carries the most investment risk? A. Whole life. B. Universal life. C. Variable life. D. Term life. Answer: C. Variable life. Variable life insurance policies offer policy owners the greatest control over how their cash values are invested, typically allowing them to choose from a variety of sub-accounts within a separate account. However, this control comes with the highest investment risk, as the cash value and death benefit can fluctuate significantly based on the performance of these chosen investments. Unlike whole or universal life, the policy owner bears the investment risk, which is why agents selling variable life must hold a securities license in addition to a life insurance license. Question 22. In Ohio, if an insured's age was understated on a life insurance application and discovered after the policy was issued, what action will the insurer typically take? A. The policy will be voided. B. The death benefit will be adjusted to the amount the premium would have purchased at the correct age. C. The policy will be cancelled, and premiums refunded. D. The insurer will require the insured to pay the difference in premiums for past years. Answer: B. The death benefit will be adjusted to the amount the premium would have purchased at the correct age. The misstatement of age or sex provision in Ohio life insurance policies dictates that if an insured's age was understated, the death benefit will be adjusted to the amount that the premium paid would have purchased at the correct age. This ensures that the insurer receives the proper premium for the actual risk, without voiding the policy entirely. It allows the contract to continue on equitable terms, reflecting the actual risk covered. Question 23. What is an unfair trade practice regarding rebating in Ohio? A. Offering a prospective client a free T-shirt for completing an application. B. Returning a portion of the premium or offering something of value not specified in the policy as an inducement to buy. C. Providing a discount to a client who purchases multiple policies from the same insurer. D. Charging a service fee for helping a client file a claim. Answer: B. Returning a portion of the premium or offering something of value not specified in the policy as an inducement to buy. Rebating is an illegal unfair trade practice in Ohio where an insurance producer offers something of value not specified in the policy, such as a portion of the premium, a special favor, or an item of value, as an inducement for a client to purchase insurance. This practice is prohibited because it can lead to unfair discrimination among policyholders and compromises the integrity of the sales process. Producers must sell policies based on their merits, not on special inducements. Question 24. What is the purpose of an assignment provision in a life insurance policy? A. It allows the policy owner to change the beneficiary. B. It permits the policy owner to transfer ownership rights of the policy to another party. C. It requires the policy owner to assign an agent to their policy. D. It designates how dividends will be paid. Answer: B. It permits the policy owner to transfer ownership rights of the policy to another party. An assignment provision allows the policy owner to transfer some or all of their policy ownership rights to another party, either collaterally or absolutely. A collateral assignment, for example, is often used when a policy is pledged as security for a loan, where the lender becomes a temporary assignee of policy rights. An absolute assignment transfers all rights permanently. This provision provides flexibility for the policy owner to use the policy as an asset. Question 25. Which dividend option typically results in the policy owner receiving a check directly from the insurer? A. Applied to reduce premiums. B. Paid up additions. C. Cash payout. D. Accumulate at interest. Answer: C. Cash payout. The cash payout dividend option means the policy owner receives a direct payment, a check, of the policy's declared dividends from the insurer. This option provides immediate access to the dividend funds, offering a tangible return on the policy. Other dividend options like applied to reduce premiums or paid up additions apply the dividends back into the policy, either lowering future payments or increasing the death benefit and cash value.